This is episode 274 of Zen and the Art of Real Estate Investing with my guest, Andy Weiner. Andy is the founder and president of RockStep Capital. He is a shopping center investment specialist focused on hometown markets. Andy, welcome to the show.
Jonathan, excited to be here.
Yeah, I'm excited to talk to you. I know I was rushing to get here at the last second, but I'm really excited about this because we haven't really had a deep dive into shopping centers. And I know we'll get there, but I wanted to drop back and start with the name of your company, RockStep Capital, because I know that it's meaningful to you and it has a backstory.
It definitely has a backstory, Jonathan. So the word rock step is not a word in the dictionary, but it is a dance move.
Yeah.
So dancers know what a rock step is. And so I like big band music. I like Frank Sinatra, Ella Fitzgerald, Peggy Lee, Sammy Davis. So from the 50s, 60s genre of swing. And when you swing dance or couples dance or ballroom dancing, you're rock stepping on count 7 and 8. 1 to 3, 1 to 3, rock step or ball pivot change. And so we use the term rock step as a metaphor to be nimble, light on our feet, listen to the music in the industry, and then pivot. So if there's an opportunity, hey, Jonathan, we got an opportunity here, we need a rock step. Or Jonathan, we got a problem here, we need a rock step. So we use it as a verb, everyone here at the company. We've got about 100 employees. We're a vertically integrated real estate investment company based in Houston with assets in 11 states. Then I wrote an owner's manual for our company, and I wrote 25 rules of behavior, specific verbs, rules that everybody has got to live by. And we call these rules.
Got to be the rock steps.
We call them rock steps. Yes,
Yeah.
you win, Jonathan.
Yeah.
Congratulations.
Yeah.
Congratulations, Jonathan. So these are them right here.
Yeah.
They're in a little booklet. And we have a rock step of the week. And for the last 9.5 years, we've been rotating twice a year. It just so happens that this week is rock step number 2, practice A+ness. Okay. And the joke my kids say, hey, Dad, there's a difference between an anus and an A+ness. Okay. So every Monday, and it happened yesterday, the whole company gets on a Teams call. We talk about the rock step of the week. Somebody writes a little essay and they call randomly on people. What does it mean to you to be A+ in your personal life and your professional life? This is how we hire people. What are your favorite 3, Jonathan, and why? What are your most challenging 3 and why? We're required to live by these behaviors. It's how we manage conflict. It's how we build trust. We've got people from Brookfield and CBL and Blackstone who've come to our company who want to be part of a high performance team that lives by certain behaviors. And so I'm emotional about this stuff. I go to the mat on this stuff, cry over this. We talk about it. We use the language. We're not perfect. We're required to live by these rules with our investors, between everyone here at RockStep, our communities, our tenants, our lenders, our professionals, and it is the most important thing about this company.
So for someone though who's smaller and they're thinking, hey, I'd like to get involved in shopping centers, can they start this on a small scale and test it out, before they get to the true larger shopping center?
If they want to do their own investment buy assets.
Yeah, like a 4 to 8 unit strip mall type of thing. Is that like a good training ground?
I actually think it is. So let's say you want, now again, could you develop new? The problem is construction's so expensive.
Yeah.
So I would recommend properties under $2 million that have 3 to 5 to 7 tenants in a part of the market that is viable. Okay. And again, what you look for is you're looking for what we call essential drivers. Does this hometown have something that drives growth? I'm talking about population growth.
Yeah.
Does it have a major university? Is there a military base or a government research facility or both? Are there Fortune 1000 companies there? Is there a major hospital district? Is tourism? You need something to drive population growth. And if it has that, then you can identify these smaller opportunities in these markets and maybe from an operator who's not, their end of their life cycle. They want to sell it. It wasn't managed well. They're going to have to put down 50% equity or whatever the number is, and then put their balance sheet on the line. One thing I would recommend, Jonathan, is for people who aren't familiar with shopping centers, our mission as a company, besides making hometown America better, is that we want to be the country's leading educator in investing in shopping centers. So we have a learning center. So online, you go to rockstep.com, you go to the learning center, and we have dozens and dozens and dozens and dozens and dozens of articles about every single part of understanding a shopping center, the different types, how lease works, lease terms, everything associated with construction and design, how to manage, everything associated with articles. And then we have videos. So we have a YouTube channel called the Shopping Center Channel. And on Instagram, I'm the Shopping Center. So you can go and follow us on Instagram. But if you like the idea of investing in shopping and you want to do it yourself, you need to study.
Yeah, for sure.
You got to study, learn the terms, learn the different designs, and then you go from there. You got to figure out you got to figure out your capital exposure, roof, parking lot, lighting, those kind of issues. You got to figure out your tenant improvement dollars. What kind of absorption will there be if somebody leaves? What's the viability of each tenant? All that kind of stuff that you have to do, very frankly, in any sector.
I was just talking about how it was so interesting to have that fund set up, and that's great for investors who want to get involved in shopping centers, have some extra income to invest, but don't want to try to do it on their own because, as we were saying, it could be a little difficult.
So we're in a transition, where we were doing deal by deal syndications, and we seen Hometown America. And the reason why we've done this is that particularly in the opportunistic sector, enclosed malls, but also other types of shopping centers, sellers are almost requiring that you have a fund in order to win the deal. They want committed capital. And so, buying the property right at the lowest possible price is one of the most important indicators of the success of the asset, of the end. So that's why we have a fund. Investors get the advantage of diversification. And because we're a yield play, we can pay a preferred 8%. That we pay a current preferred of 8%. That's what we do. And, it's a current yield play. And particularly in the enclosed mall space, we bought some malls, like we bought one in Kansas at a 17 cap with 50% leverage. We're returning 8% a year. And in this deal, 20% of the original capital per year without a refi. That's without a refi. So, it
gives you the advantage too as a buyer because you do have the fund and obviously the reputation where it's going to knock out all those people it makes sense. Why would someone want to sell to a one-off? It's very unreliable.
Yeah. So that's our game plan. And again, we look at every single mall opportunity on market and off market in the, in the mall space. And, there's, I don't know, $40-50 billion of insolvent debt underlying malls. It's getting repriced almost at land value in some cases, but at mid-teens cap rates. That's where, and it's very, very good real estate. And in the mall sector, there's three strategies, John. And we employ all three depending upon the market and the asset. One is just harvest cash. It works. The architecture works fine for the next 15, 20 years. Just harvest the cash, pay back equity quickly. Second is arbitrage in the periphery. So you buy something at a mid-teens cap rates. So we did this in Rapid City, South Dakota. We bought it at a 20 cap rate for $12 million, a mall there. We sold the periphery off for $18 million. Still have the mall throwing off $2.5 million of cash per year with no basis.
Yeah. That's nice.
And then the third one is shrink retail. Okay. Shrink retail and do something else. So we're demalling 6 of our malls. One is led by Target. One is led most likely by Costco. 3 are Ross and TJ's. that is led by Ross and TJ's, and one by a hockey arena. City's building a $50 million hockey arena on our mall site. And as a
Wow.
result,
Okay.
we'll do multifamily and we'll do some hospitality there as well.